All right, folks, welcome to today's workshop. Thank you so much for your patience here. We have quite a bit to cover today, so I really want to make this extremely good for you. And so I put a good amount of time, and on that note, we're probably going to be here for a little while. So I want you to plan for at least 60 minutes, possibly to a little over an hour, because there's just a lot to cover here. For those of you that signed up through the Zoom link prior to about, I think, 10 or 11 o'clock this morning Pacific time, you should have gotten 3 different guides, okay? One guide is the 2025 important numbers, which hopefully you already have, the 2026 important numbers and key changes, and then also a pretty extensive checklist for your end of year planning. So if you didn't get that, I'm going to put my email address at the end. Go ahead and send me an email, and I'll make sure that you get that. I wanted to make sure that everybody got that a couple hours ahead of time at least. And if you do have it, I would recommend pulling that out. For those of you that don't know me, my name is Jason Hamilton. I'm the founder of Keep It Simple Financial Planning. I'm a certified financial planner. I've really been specializing in helping people with retirement planning for about 10 years now. This is an area of work that, one, there's a ton of value, but the second thing is it just keeps getting more and more complicated, okay? So I'm going to try to make things as simple as I can. But this new One Big Beautiful Bill Act, along with the Secure Act 1.0 and 2.0, and even back to the Tax Cut and Jobs Act and back in 2017, have all had things that need to be reviewed and checked on if you're somebody that is near or in retirement. I'm going to do my best to cover as much as I possibly can, and I do have to let you know, this is not for any sort of individual tax advice, legal advice, or investment advice, okay? But I do want to make this very useful for you, so there's a lot of good, hopefully some good info for you here. But glad you can hear me. If anything comes up, go ahead and just use the Q&A to ask a question. And if I see a Q&A come in like you can't hear me or something's going wrong, that's good. That's a good spot to put it. If you have questions, you can also use the Q&A, and then I will take some time and we're going to get to those, okay? I do recommend if you are on a phone, that you move over to at least an iPad, if not an actual computer, because there's just a good amount to cover, and I was trying to make it as simple as I can, but there's certain things I think are better if I just put them all on the screen. Okay, so I know the print's going to be a little bit small on some of the slides, but I think it was better in those cases when I did that to add more information than to not add more information. So that's why I did send out in that email for you to hopefully join with a larger screen. So without further ado, let's jump in here and talk about end of year planning for 2025. And we're going to talk about really navigating these key changes, because it really is a navigation. There's so many directions you can go with a lot of these things that it really is going to come down to what you're individually comfortable with or what your individual situation is. And so I want to make sure that this is tailored to you, but keep in mind that, again, this will all need to be reviewed with either your financial advisor or a tax advisor to help you get through some of these things, okay? So what we're going to cover today, it's a long list here, okay? But we are going to talk about tax planning strategies before December 31st, the One Big Beautiful Bill Act and what has changed and what stayed the same as well. Retirement account decisions, investment and capital gains planning, Medicare and Social Security considerations, estate and charitable giving, and looking ahead from 2026 to 2029. And I want you to walk away with some specific action items. I want this to be a working session where everybody here is going to walk away with specific action items for them to actually go and implement. Okay, I'm happy to do this. I do this at no charge. Most of you are not my clients, but my ask is that you walk away and you implement at least a few things that we covered today, because I really do think they're going to be beneficial. And we are going to also talk about some tax planning around Roth conversions, decisions around that, and some case studies with that, okay? Because that was a big request. When it comes to the end of the year, December 31st is really a critical deadline for tax planning. Many tax strategies and deductions expire at midnight on December 31st. For example, if you go ahead and you try to go ahead and put a Roth conversion in on December 31st, if your custodian counts it, it will count for 2025, but if not, it's going to end up for income for 2026. So I recommend you do some of these things prior to December 31st, but that is the expiration date. decisions you make now can have a big impact on your 2025 tax return. And some of these year-end moves can reduce your taxes for years to come. Okay. There's been significant tax law changes that are coming in 2026. And so it's important to plan ahead for those as well. And so I really want you to take action before the end of the year. That's why I'm doing this here at the end of the month and really have a full 30 days to get some of this implemented here. So hopefully you take me up on my offer and assistance to do that for you here. Okay. So the first place we want to stop is understanding where you stand. If you have the guides that I sent you out by email today, it's a good time to pull those out and you can look at this. You always want to know where you stand because when it comes to tax planning, it's all about bracket management, right? So it might be a marginal tax bracket, or as we're going to talk about in the future here, Irma tax brackets, because these are really important if you're somebody who wants to do Roth conversions. But the 2025 tax brackets are listed here for both married filing jointly and single filers. And it provides what the tax rate will be on the portion of income between the two numbers that you see there. For example, you are going to have a standard deduction, which we'll talk about those here shortly. But once you start getting into taxable income, then the first dollar to $23,850 for a joint filer is going to be taxed at 10%. So on that amount of money, between those two numbers, you're going to owe 10%. So that full bracket there would be $2,385 of tax. In the 12% bracket, that's between $23,851 and $96,950 for joint filers and so forth. So getting comfortable and understanding how these marginal rates work is really important when it comes to your tax planning. And it can also be very important to when it comes to your distribution planning. Should you take money out of an IRA, like a pre-tax account, or should you defer taking out of that and taking out of a Roth account this year because your tax bracket's going to go up, right? All things we really want to look at. And so I encourage you, as at least one takeaway action item today, that you figure out exactly what tax bracket you're in and how much potential taxable income you have left in that particular bracket. Okay, I'm making a point here about the 12% bracket because I want you to, no matter what, okay, and this is something I don't want to say it's tax advice, but let me just say I strongly recommend you consider that if you are below the top of the 12% bracket, this is a really important bracket to consider for you in 2025 and beyond. Because this bracket here, to me, I call it like the no-brainer bracket in a sense, where if you have money left in a 12% bracket and you have pre-tax savings like in an IRA, that you should really consider doing something like a Roth conversion or potentially distributing that. Because more than likely, if you're going to continue to not draw from your IRA accounts, you might go up a bracket in the future. But if it really looks like you won't, then you may not have to do this. But if you are somebody who has below taxable income of $96,950 in 2025 and you're filing joint, then you are going to be what's called in the marginal tax bracket of 12%, okay? And so something that's really interesting is you can stay in the marginal tax bracket of 12% and make quite a bit of money. So for those of you that are 65 and older, there's a new deduction that's active this year through 2029, and it's called the Enhanced Senior Deduction, or there's a lot of actually different names for it, but it's $6,000 per tax filer, okay? And so you're going to take your income that you earn, and you're going to be able to start with a standard deduction of $31,500 for joint filers, add another $12,000 if both of you in the couple here are 65 plus, and then add another $96,950 and still stay in the 12% bracket. So you can actually have up to $140,450 of total income and remain in the 12% bracket, which is pretty amazing. For single filers, it's about half of that is $70,225, okay? And so what's also important here is if you're currently married and you have a large pre-tax account of some sort, whether it's each person of the couple has large accounts or one person has a large account. If one of you were to pass early, okay, then you have to remember your tax brackets are going to get cut in half the year after that particular person passes away. So if today it looks like your RMDs, your required minimum distributions, which you have to take from your pre-tax accounts at either 73 or 75 now, if it looks like, hey, I'm never going to hit the 22% bracket while I'm married, but take another look at that and see, hey, will I actually go into the 22% bracket or higher if I was on single filer tax brackets? Because if you do, then that's another reason you may want to consider accelerating income. So I want you to at least focus on maximizing the 12% bracket. Going to 22 or 24, a little bit higher, that does take a little bit more analysis and a little bit more long-term view. But for somebody in this particular situation that's 65 or older, these numbers are quite large now. Obviously, if you're not 65 yet, you would take off either the $6,000 for single filers or the $12,000 for joint filers, and that would be the amount but you would be able to have in the 12% bracket. So it's still around $128,000 for joint filers and around, $58,000 or so for single filers. So it's quite a bit of money, and I really want you to make sure that you walk away looking at that at a minimum today. Okay, the other thing here, again, this is a slide I know it has a lot of stuff on it, okay? I will send out this recording here so that you can go back and you can pause this and you can zoom in. I want you to have this information here because when it comes to figuring out where you're at in the overall taxable income situation, you have to understand how your Social Security is going to be taxed, okay? Prior to being on Social Security, you only had to deal with 2 tax brackets. That was your marginal brackets that you've been used to all the way through your whole life, the 10, 12, 22, 24, what is it now, 30, 32, and 35, okay? And you're also your capital gains bracket. So that's if you were to have some sort of stock or something like that in your life, okay? So I don't know why this is popping up behind. Let me get rid of this here really quickly. Excuse me. Let's get this guy out of here. All right. Anyways, it's going to do its thing. So when you have Social Security, there's a new tax bracket that's called provisional income, okay? And provisional income is calculated by this additional calculation you have to do to see how much of your Social Security is going to be taxed. So at the top here, I have the formula for you. The formula is your AGI, so that's any other sort of income. So let's say you have a distribution from your IRA, for example, of $30,000. Then you would add any non-taxable interest. That would be like municipal bond income. Let's say you had some municipal bonds in your brokerage account. And then you would add 1/2 of your Social Security benefits. Okay? And if that amount is above one of these numbers here that you're seeing here, either under the threshold for married filing joint or for single filers, now you have to think about your Social Security potentially getting taxed, okay? But if you're below these amounts, the good news is your Social Security will not be taxed. So you may have heard that this enhanced senior deduction of $6,000 per tax filer was also being called the no tax on Social Security deduction. I can clearly tell you that the deduction really has nothing to do specifically with Social Security outside of the fact that it will help you lower your AGI. Because if you have an additional $6,000 on top of your standard deduction, that's going to lower your actual AGI. But when it comes to seniors, this new enhanced senior deduction has brought 66% of people paying no tax on their Social Security up to 88% of people paying no tax on Social Security. So it can get a little tricky here. But when it comes to calculating your provisional benefit, you want to take your AGI plus non-taxable interest plus half your Social Security and figure out where you are on these brackets. Okay, if you're above $34,000 as a single filer or above $44,000 as a joint filer, you can pretty much assume that 85% of your Social Security is going to be taxable income to you, okay? So going back to the 12% bracket, if you have Social Security income, in this case here of $30,000, and you have an IRA distribution of $45,000 and taxes of interest of $2,000, you can see here that of your $30,000 of Social Security benefits, about $25,500 will be taxable income that you need to start stacking up when it comes to your income sources as you add those up. Obviously, IRA income is 100% taxable, and if you are selling something from your brokerage account like single stocks or even mutual funds, only the gain, the capital gain, is going to be taxable there, okay? So you need to understand the income sources you have coming in to figure out where you're at in the 12% bracket. And one of those calculations will be your provisional income calculation to see what percentage of your Social Security will be taxed, okay? And if you're below 85, then it gets a little bit tricky and you want to get into a calculator of some sort to help you out, okay? For next year, the tax brackets are going up a decent amount. So you can see here where the joint and single filer tax brackets are going up. And then the standard deduction is going to go up to $32,200 up from $31,500. And for joint filers, and then to $16,100 from $15,750 for single filers. So these tax brackets have also been made permanent, and I say quote unquote permanent, with the One Big Beautiful Bill Act, because really if there's another tax plan of some sort, another president or Congress could come in and change that. But what we had prior from the Tax Cut and Jobs Act was that these tax brackets were going to be secured through the end of 2025, and then they were going to go up after this year. So the One Big Beautiful Bill Act did lock those in place, which is great, by the way, because if you're somebody who is, let's say, at the top of the 22% bracket, your additional federal tax would have been about $5,300 if those brackets went up from 12 to 15 and from 22 to 25. So this is a significant tax savings that most people are going to be realizing, but this is really great news. So when it comes to the One Big Beautiful Bill Act, and I'm going to call it O3BA, okay? So there's 3 B's in it. So for you Star Wars nerds, that might sound something familiar to you. But the O3BA Act, the major changes that you really need to know are as follows. The tax brackets are now made permanent, okay? Like I said, I put a quote on that because of the reason that those could technically be changed, but ideally they're not changed, but now we know for sure they're not going up next year. There have been new deductions for seniors. So that enhanced senior deduction, which is beautiful. I really think that has helped a lot of people out from what I'm seeing this year. The no tax on tips, no tax on overtime, and no tax on car loan interest. We're going to break those down a little bit more. This SALT deduction for those of you in high income tax states like California, New York, and so forth, this has really been a great one for most people. But if you make from between $500,000 to $600,000, there's a very fast phase out. So you got to watch it there on your tax planning. I'll talk about that in a bit here. And then the child tax credit increase to $2,200. There's a new, what they're calling a Trump account savings option for children, with like a 529 alternative with some other benefits. And the estate tax exemption was raised to $15 million. That was set to revert back to what it was on an inflation adjusted amount from 2017, which would have been about $7 or $8 million, which I think a lot more people would have been impacted. So that is now been taken care of and gone, which is great. Okay, our next one here is this senior standard deduction bonus or enhanced senior deduction. The thing to know about this is you need to be 65 and over. It's active from 2025 and set to run through 2029, and it's $6,000 per individual. And this is where it can get a little tricky for those of you that may be looking at doing something like accelerated income through a Roth conversion. This deduction starts phasing out between $75,000 for single filers and $175,000 for single filers. For married filing joint folks with incomes between $150,000 and $250,000, there's a phase out through that range. Okay, so it's not a pure drop off, it's just a phase out. And so you want to look at making some conscious decisions on accelerating income in any particular year, especially this year, that if you are looking to do a Roth conversion, you may be giving up some of this deduction, okay? So depending on your time frame, let's say you're in your early 60s and you have 15 years or so to do Roth conversions before an RMD kicks in at age 75, maybe you just want to take this whole deduction in the next 4 years and then focus on Roth conversions after that. If you're somebody a little bit closer to your RMD age, then you may want to just eat up some of this deduction by doing a Roth conversion and just let it go. And it's not really that big of a deal, but this is something, again, that will be based on a very individualized type of planning. And so you want to make sure you look at that for you in your actual situation. Okay, so there's 3 key deductions we're going to cover today from the O3BA. That's the no tax on tips, no tax on overtime, and no tax on car loan interest. We've talked about this here before. But for tips, up to $25,000 is deductible. But there is a phase-out range, and that phase-out range is between $150,000 up to $400,000 for single filers. So technically, you can make up to $400,000 and still get some of this deducted for joint filers. And, that's for single filers. And for joint filers, it's between $300,000 to $550,000 if you're married filing joint. So if you're a joint tax filer and you have one of the people in the household making tips, you can make up to $550,000 and still get some of this deduction. Very strong income range on that. The overtime pay deductions allow up to $12,500 for single filers or $25,000 for married filing joint. And there's a phase-out range of $150,000 to $275,000 for single and $300,000 to $550,000 for married. So a little bit different there. When it comes to the overtime pay, what you have to understand about that, and a lot of people are upset about this, okay? It's just the 0.5 of your overtime hour, okay? So let's say you make $20 an hour, and that's for your 40 hours. And then you go into overtime, and for overtime, you make time and a half. So now you make $30 an hour during that overtime pay. It's just the $10 an hour difference that becomes deductible for you, okay? A lot of people are upset about that, but to me, the way I look at it is any sort of tax policy is essentially just encouraging behavior, right? And so what they're trying to do is get people to work more hours and be more productive. That's the way I see it. But again, I understand people are really upset about that, and I get it. For the car loan interest, you can deduct up to $10,000 on loans for U.S. assembled vehicles, okay? There is a phase-out range of $100,000 to $150,000 for single filers and $200,000 to $250,000 for those married filing joint. So as you can see, these phase-outs are just crazy. I really don't think you can do good tax planning without professional software anymore, but that's just my opinion. But this, if you have all these deductions and stuff, you really want to be able to look at this and make sure you're maximizing it, because this could be a lot of savings for you potentially. But when it comes to the car loan interest deduction, you have to get a vehicle that its final assembly was in the United States, okay? So it should be on the sticker when you go to buy, but an easy hack is to look at the VIN. And vehicles starting with a VIN with 1, 4, or 5 indicate the final assembly was done in the US. So that does qualify for the deduction if it was done in the US. And again, there's other ways to look at it. It should be on the sticker, but there's also a trick as well, okay? If you first of all, it has to be a new vehicle, right? So that's number one. And you have to be the first one to buy it. There is a trick though. Let's say you bought a vehicle in 2024 and the loan was established in 2024. If you refinance that loan in 2025, for example, that does now count as a new loan. As long as the car was brand new to you when you bought it, you could refinance it and still qualify for this deduction in 2025. Again, this is very tricky, not tax or legal advice, but there are ways around this if you bought a vehicle in a recent time, and then you can actually reestablish that loan. And I don't want you to go just pay more interest to go get a tax deduction, but as rates are dropping, or maybe your credit score has gone up, maybe you are able to refinance the loan and get a better interest rate, and that would be a beautiful thing. Something there to look at, okay? All right, the state and local tax update here. This is a big deal, like I said, for those in higher tax states. But one important thing is if you are a high earner and you're earning between $500,000 to $600,000 for single or married filing joint taxpayers, okay? If you're in that range, you're going to have a very fast phase out, okay? But even if your income's above $600,000, you can still claim the minimum $10,000 SALT deduction as an itemizer like it was before. But in between $500,000 to $600,000, you'll want to do some serious tax planning because the effective federal tax rate in this income band can reach up to 45.5%, okay? So looking ahead to 2026 and beyond, the SALT deduction cap will increase further. It's going to go up, I think, 1% per year, so $40,400 in 2026 with a phase-out range of $505,000 to $605,000. And that $10,000 minimum deduction for high-income itemizers will also be preserved. All right, really, the key takeaways from this slide are that the current and upcoming estate and gift tax exemption amounts, as well as the gift tax annual exclusion rate and tax rate, are going to be probably higher than anybody here watching this is going to have to worry about in their lifetime. But in 2025, the lifetime exemption will be $13.99 million per individual. This means a married couple can effectively shelter $27.98 million from estate and gift taxes. And in 2026, that's going to go up to $15 million per individual or $30 million for a couple. The annual gift exclusion, which that means you can just give money to somebody, is $19,000 per recipient per year without using up your lifetime exemption. This is a very important tool for tax planning for somebody who wants to be gifting to your children, for example, or grandchildren. And it's $19,000 per recipient. So each member of the household, like grandpa and grandma, can both give $19,000 each to each grandchild if you wanted to do that, okay? And that does not affect the lifetime exemption. Even if you went over that, by the way, you just have to file a tax form, which is annoying, but it's not like you're really going to go over this lifetime exemption of $15 million each for most people, okay? So if anyone on here is watching and you think you might have a problem with being at $15 million, please reach out to me because I've never met anybody yet that has that case, okay? Personally, I should say. All right, we're going to shift gears here a little bit and to talk about the subject of timing your income, okay? So when it comes to timing your income, if you're somebody that is in retirement, we have a lot more control over this than for somebody that's pre-retirement, right? If you are just earning an income from a salary job, for example, you're just going to get the same paycheck regardless of kind of what goes on. If you're in retirement and you have multiple account types, so let's say you have a pre-tax retirement account, you have a post-tax retirement account like a Roth IRA, and you have a taxable or a brokerage account, just like a basic brokerage investment account, and maybe you have some cash accounts like high yield savings accounts, for example. When it comes to how to fund your retirement, it can get really tricky if you're trying to optimize for certain tax brackets. But some high level things to think about are if you expect to be in a lower income year next year, you might want to consider deferring your income. If you expect to be, if you're right on the threshold of a bracket, so when we talked about that 12 to 22% bracket, if the next $1,000 you take out of your account is going to be taxed at 22% versus 12%, that's almost double. That's an additional 10% taxes. You might want to just delay and take some money from a Roth account, for example, or just use some cash for your income needs that year. On the other hand, if you are going to be in expected higher income bracket next year, you might want to consider accelerating some income. So you want to take advantage of the current tax brackets, especially if you have room in a bracket. So as I was showing you before, that 12% bracket, if you're below the $96,000 and change, you might want to consider accelerating some income, whether that's just taking a distribution from a 401k or IRA or converting that money to Roth for later use. And things like Roth conversions have become very popular, but they can be a lot more complicated than you think. I'm going to walk you through a few of those things today. So all things to think about there, and this will be individualized type of situations and advice. The other thing is you do not want to waste space if you can take and harvest some gains from, let's say you have a brokerage account or you have some old stock that has gone up in value. Selling investments at a loss can be a strategic way to offset capital gains where you've gained somewhere else and reduce your tax liability. You can also deduct up to $3,000 of investment losses annually against your ordinary income each year. So that's a cap there. But with that investment loss, if you did have some loss that you did capture, you can carry that forward to future years to offset future gains. There's no specific tax code, but as of right now, it's assumed that it's just going to be forever. But you do want to be mindful of what's called the wash sale rule. Okay, the wash sale rule is you cannot buy the same or a substantially similar investment 30 days before or after the sale. Okay, so let's say you were doing some tax loss harvesting and you had an S&P 500 ETF, for example. You want to be careful because you don't want to just go buy another S&P 500 ETF that's exactly the same. Like it says here, substantially similar or the same, even if it's from another company. But could you go use a large cap growth or a large cap value, some other sort of large cap ETF that's very similar, but not substantially similar to that S&P 500, still have your money, that same amount of money in a similar type of, so you get the same type of growth, and then wait 30 days before you repurchase again? You could probably do that. Again, this is not tax or legal advice. The other thing you want to look out for is year-end capital gain distributions from mutual funds. This is something you can actually request from your custodian. And this is something that it causes a lot of people problems, by the way, and it can create an unexpected tax liability. So you really want to be aware of this issue, especially if you're somebody who uses target date funds, which I do not recommend, by the way, outside of retirement accounts. There was a big lawsuit that Vanguard had to deal with because they had substantial gains in their target date funds a few years ago. And there was a lot of money that rushed out to go to a lower share class, and it caused a huge capital gain trigger. And so when it comes to where you're putting your money, you always want to think about asset location strategy, right? And you want to make sure you have the right assets in the right place. So you probably want to be holding different assets in a brokerage account than you would in a pre-tax account or a Roth account, for example. Not always, but that could be the case. Okay. But as we talked about the 12% tax bracket marginal rate opportunity, I want to talk to you about the 0% capital gains opportunity, because this can be a very powerful strategy for those of you with taxable income below certain thresholds. So if your taxable income is below $97,600 for married filing joint or $48,350 for single filers, you may be able to take advantage of this. You may have noticed that these amounts are very similar to the 12% brackets for both of those tax filing statuses, but they're not the same. They're a little bit different, so you have to be careful with this, okay? But this will allow you to sell appreciated investments tax-free. You can also reset your cost basis higher. So what that means is the floor, you could say the cost basis is the floor, and it can help you reduce your future tax liability. Okay. So now's a really good time to look into this if you have taxable brokerage accounts. So this can be particularly valuable for retirees in their lower income years when they may have more flexibility to take advantage of this. So if you're pre-pension or pre-Social Security and you don't have any other income sources coming in, maybe you're living off cash, this could be a really good year to look at this. But the key is keeping your taxable income low enough to qualify for 0% capital gains rates. Very important. And this can help you also maximize your after-tax returns and set you up for a more tax-efficient investing in the future. At the end of the day, investing is great, but you always want to be thinking about maximizing your after-tax returns because that's what you actually get to keep. That's the usable income or the usable wealth from which you can use from your investments, okay? All right. So let's talk about managing investment taxes a little bit here. The key capital gains rates, as I mentioned, for 2025 for married filing joint are 0% up to $96,700, 15% between $96,701 and $600,050, and then 20% on taxable income over $600,050. You also want to watch out for this gotcha. There's a potential 3.8 net investment income tax if your MAGI income exceeds $250,000 for joint filers, and that's $200,000 for single filers. For single filers, obviously it's about half of that, okay? As an example here, if you take the single filer with no other income, you could actually realize up to $72,100 in long-term capital gains and pay zero in federal income tax. For married filing joint, that's actually up to $143,400. So this just demonstrates how strategic tax planning can help you maximize the amount of capital gains that can be realized at the 0% capital gains rate. And by the way, I'm putting these strategies on an island. For most people, it's going to be an intermixing of them all, right? So you want to make sure you're looking at everything all together. All right. All right, now let's talk about savings rates and maximizing your savings for 2025. Here are the contribution limits for the various retirement accounts in 2025. 401ks, 403bs, 457s, and TSPs have a $23,500 limit with a $7,500 catch-up for those age 50 and older. But if you are between age 60 to 63, you have what we're calling the super catch-up of $11,250 that's only available between age 60 and 63, okay? So a little tricky here, but this is for a part of the new tax plan. Traditional and Roth IRAs have a $7,000 limit, and it's an additional $1,000 for those age 50 and above. A couple important deadlines to remember. You have to put money in your qualified plans, like your 401ks, your employer plans, I should say, before December 31st. And you have until April 15th for the IRA plans, okay? So if you have to make some choices of where to put money now, emphasize putting money in your employer plan, and then you can always fill up the rest of your Roth IRA or whatever it may be after the year up until April 15th for 2026. For 2025, you can go into 2026, okay? Now, these are the new contribution limits that were announced for 2026. So all of them, most of them have gone up a little bit. Your 401ks and other employer plans are going to be $24,500. For those age 50 and over, there's going to be a catch-up contribution of $8,000. So these are both significant. It's about $1,500 more you can put in now. For those age 60 to 63, the super catch-up has stayed the same at $11,250. For traditional and Roth IRAs, it's gone up $500 for the contribution limit, and the additional catch-up is still the same, so you can put up to $8,500 total there. And for your HSA accounts, the individual account limit is $4,400, and for a family, the limit is going to be $8,750. So these limits are very important to keep in mind when planning your retirement contributions because they're all very useful when it comes to creating income that's tax efficient that helps you keep most of your money from the government. And my philosophy is I work with people that are more than happy to pay their fair share, but I don't want people to pay more than their fair share and give the government a tip, right? So if you're somebody who wants to avoid giving the government a tip, working on your tax planning is the right thing to do. I think you will do a better job with that extra money than they will. That's my belief, but maybe not everybody, okay? And that's okay. Right, so let's shift and talk about Roth conversions. This was one of the most popular topics when I put out for this training, what you want to talk about. It was Roth conversion, Roth conversion. So this is going to be a big portion of our workshop, let's just say, because I think most people here could benefit from some sort of Roth conversion strategy. What the strategy is going to be individualized, but I think pretty much everybody here can benefit, okay? Now, pre-tax accounts like traditional IRAs and 401ks are actually the worst place to keep your money. So I want most of you to get as much money out of there as possible before you pass away for many reasons, okay? But let's talk about why to consider a Roth conversion. One, you're going to pay taxes now at a known rate versus an unknown future rate. You're going to get tax-free growth and tax-free withdrawals in retirement. There's no required minimum distributions during your lifetime. And then the nice thing is, if you leave money behind for your kids or grandkids, it's going to be a tax-free inheritance. And if it's a pre-tax account you leave behind, there's a required RMD, which if you didn't know now, the accounts have to be fully distributed within 10 years. So if it's a pre-tax IRA, whoever inherits the money is going to have to take an RMD each year over the 10 years. But if it's in a Roth account, there are no RMDs required. So what I recommend for my clients, if it's possible, is to start educating your kids and grandkids, saying, hey, I'm going to leave you some money in what's called a Roth IRA account. What I want you to do is not touch that money for 10 years. And let's just use the simple rule of 72, where the rule of 72 tells you to take how many years and the rate of return that you get and divide it by 72, and it'll tell you how long it's going to take your account to double. So for example, if you have a 10-year time frame and you get 7.2% return, then that account is going to double in 10 years. So if you can have someone that inherits a Roth IRA that's worth $100,000 when you pass away, and they can let that money sit and invest it and get at least 7.2% on average, that account could be worth $200,000 or more, and they can take it all out tax-free in year 10. If the money's in a pre-tax IRA account, it's going to have to get taken out along the way. And if they're in their higher income earning years, well, up to half of that account maybe just be given away and eaten up by taxes, okay? So what we're looking to do when you're considering Roth conversions is we're really just hedging against future tax rate increases, and we're setting ourselves up for a better experience throughout retirement. The way I see the best candidates are as follows. Those of you that are in low tax brackets now versus what you're expected to be in the future. Those of you with room in a current tax bracket, so like I mentioned, that 12%, for example, or maybe even 22 or 24. Those of you with a long time horizon, so if you have good health, and that's a good reason to think about it. If you're married, this could be a really good reason, because if you are married and one spouse passes away prior to the other one, which again is unfortunate, right? But if you're married and one spouse passes away prior to the second, then you get what's called the widow penalty, where your tax bracket's cut in half, but your RMDs are still going to be about the same size. So what that can do is push you up in tax brackets, and it can also push you into penalty for what's called Irma, income-related monthly adjustment amount on your Medicare later in life. So this can be a really powerful strategy for those of you that are married with large pre-tax IRA balances. And it's also great for those of you that just want to be on the tax legislation sidelines, right? So I'm obviously not in my 60s. I'm in my mid-40s. I just had my 45th birthday recently. But I personally split up my money between a Roth contribution to my 401k and a pre-tax contribution, because I want to just be on the sidelines with some of that money, even though I'm in a higher tax rate today than I probably will be in the future. Since I have hopefully 20 or 25 years or more before I think about retiring, I'm setting myself up like that. So Roth conversions can be a really powerful tool if you just want to be on the sidelines as well. So the core question is, will your tax rate be higher now or later? Okay. So if it's going to be higher now, you might want to defer and not convert. If it's going to be higher later, then you might not want to accelerate and start converting now. And if you're uncertain, then you could just diversify like I'm talking about doing, right? I'm doing about 50-50. You can also just convert some. You don't have to convert all the money. That's okay too. You want to have an individualized plan that makes sense based on your spending needs, your account sizes, and what your goals are for your long-term legacy. So believe it or not, there are more than one type of Roth conversion strategy to consider. And I would like to know from you, how many of you knew there's actually more than one type? But there's actually 3 types, okay? So let's review the 3 types of strategies that you may want to consider if you're looking at a Roth conversion. The 3 types are bracket-based, market timing, and Irma optimized, okay? So we're going to start here with the bracket-based conversion strategy. What bracket-based conversion strategies are is pretty much what you probably heard of before. They allow you to strategically manage your tax liability by converting from a traditional IRA to a Roth IRA. And what you're generally going to do is just fill a bucket, right? It's called the fill a bucket approach, where you convert just enough to reach the top of your current bracket without spilling into the next one. That's like that 12% maximization for the marginal bracket strategy that I talked about. So if you're married filing joint and you have $150,000 in income, in taxable income, I should say, and you're in the 22% bracket already, which ends at $206,700, you have room to convert about another $56,700 to stay in that 22% bracket. So that could be a really good strategy for you. So what the idea here is that you want to stay below the threshold. That's your approach, right? Stay below threshold approach. Keep conversions small enough to remain under key income thresholds that trigger additional costs. From 22 to 24 is not that big a deal, because if you go from 22 to 24, it's an additional 2%. But if you're going from 12 to 22, you're almost doubling your taxes with an additional 10% on that next $1,000. So this is where you want to really look into this and make sure you're doing the right thing for yourself. All right, then now the next type here. Let's talk about market timing conversion strategies. So the key logic behind market timing Roth conversions is that converting when markets are down means transferring the same number of shares, but reporting a lower dollar value as income. This will result in less tax owed on the conversion and more upside captured tax-free in the Roth, as long as you believe the market will come back. Now, I think most people here are pretty reasonable, you're very educated, and most all of you believe that the markets will come back at some point, okay? So if that's you, and you're somebody who is interested in Roth conversions, here's a general guideline, right? This is nothing specific, but I think it's a good general guideline to look at. There are a few trigger-based approaches to consider. A 10% market correction may be a good time to consider a partial conversion, right? So I'm a big fan of doing partial conversions throughout the year, because ever since the Tax Cut and Jobs Act, we have lost the ability to do what's called recharacterization of our Roth conversions. So once you convert, it's done. You can't go back, nothing you can do, it's over. Prior to 2017, we were able to go back if the market dropped and then do it again. That's not possible anymore, okay? So I've been a big fan of doing, let's say, around half the conversion early in the year and half the conversion later in the year. Because if we get an opportunity, let's say it's 20%, right? And there's a bear market, this could be a great opportunity for a larger conversion. Back in 2020, when COVID hit, and even in 2022, I helped a lot of clients do very large conversions because I'm watching the accounts pretty much every day, I should say. Maybe a lot of you are not watching it. But if someone is a client of mine and you're on my Roth conversion list, if we have a big correction like bear market of some sort, maybe 20% or more, I'm going to start calling you up and say, hey, what do you think? Do you want to do an additional conversion now and get some more money over here? Because that is going to allow us to convert a lot more shares for a lower tax cost on those particular shares. And if you have a 30% plus decline, this presents an aggressive conversion opportunity, okay? An alternative approach is just to convert specific positions that have declined rather than the entire account. So you might be able, if you're like a single stock picker, this would be good for investors that are comfortable with these tactical decisions and monitor your portfolios regularly. So let's say you have one company that just went down 50, 60%. Maybe you can convert that one over. That's another opportunity there for you for a market timing type of conversion. Now, this is one here, the Irma optimized conversions, that I think a lot of people don't really look at, okay? Because the philosophy that I hear from most people that have not been, and I'll say indoctrinated, okay? So indoctrinated is a good word for me because I feel like I have some philosophies on things that it takes sometimes some explanation and some education to help clients understand why we want to do certain things. Because it can be a great idea just to pay a little bit of Irma penalty for a few years to get a lot more money to a Roth account, which can then hopefully grow a lot more over time and be tax-free forever. So the third one here is these Irma optimized conversions, okay? So what Irma is, income-related monthly adjustment amount. And if you got the guides there, the income amounts are on those guides for you. And what it is, a surcharge on Medicare Parts B and D for higher income beneficiaries, okay? So how it works is it's a 2-year look back, 1-year penalty. So your 2024 income is going to determine your 2026 Medicare premium, okay? So that'll be through a 2-year look back period. Your 2025 IRMA thresholds are based on your 2023 income, okay? So this table shows the Part B and Part D premium amounts and the total annual IRMA surcharge for different modified adjusted gross income levels. So if you see there, when you look at IRMA level 1 there, it's $1,043 in additional cost for 1 year. But in this case, we can convert about another, $53,000 more to a Roth account for an additional $1,000, you can call it in tax, right? Going to the next level from 265 to 318, I should mention this is for joint filers, but we can have up to $318,000 of income, and we're going to pay an IRMA penalty for 1 year of $2,620. And this is per person, by the way, so you want to make sure you're doing this and make sure you're looking at this appropriately for married couples. But again, to get $300,000 over, let's say you want to do a very large Roth conversion in 1 year, it may be worth the extra payment to convert that much more money, because it's just a huge amount that you can get to a Roth account. And ideally in your Roth account, you're investing a little bit more aggressively than you might be in a pre-tax account. So all these things working together should hopefully make up the difference in what you have to pay there, and hopefully in a short amount of time, as long as markets cooperate, right? So this is the third type that I think people don't quite know how to optimize, because it does get very tricky. And you have to be careful, because with your marginal brackets, if you go from the 22% bracket to the 24% bracket, let me go back actually, you're only going to pay tax on that additional dollar that goes over, right? So if you go from 22% bracket to 24% bracket by $1, you only pay tax on that $1. With IRMA, if you go over here by $1, let's say you go from $212 to $212,001, you're paying that whole penalty. So if you have $1 over, you're paying $1,000 tax on $1. That's not ideal, right? So you want to be careful with the IRMA optimization conversion, because this is where you probably really want professional advice, because this can be really tricky. But I'm going to show you an example here of a couple situations, okay, where it could be worth it. What we have here is a kind of a Roth conversion estimated lifetime tax savings for a couple here named John and Mary. John is 69, Mary is 67. And the way their accounts are broken down right now is they have $476,000 in like brokerage and cash accounts together, so non-retirement money. John has $796,000 in his pre-tax account. Mary has $874,000. So together they have $1.6 million and $70,000 in pre-tax accounts. Okay, they have no Roth IRA accounts at this point. When I put together a distribution plan, it looks like the optimal bracket for John and Mary to convert to is IRMA bracket 3. So that's going to be up to around $300,000 of total income. But when you look at their average lifetime tax rate, it's going to go down from 15.9 to 9.2. So that's a 6.7% savings. The total taxes saved are going to go down from $1,087,881 to $555,288. So that's over a $532,000 lifetime tax savings, which means their net income for retirement is going to go up by $532,593. So let me ask you, what would you do with an additional $532,000 of retirement income to spend just by getting your distribution strategy correct? For me and my family and anybody else that I know, that would be a major change to how we're thinking about giving, how we're thinking about spending. And John and Mary here, without a withdrawal strategy, if they just did the normal, what you see online, the taxable first, tax deferred second, tax-free third, if they just followed that normal order of operations, they would be overpaying the government with a tip of over $500,000, okay? And as you can see here, the net legacy is going to go up as well by about $482,165. So this is really powerful. So this is a $1.67 million pre-tax account. So if you have a larger pre-tax account, then the impact could be larger. And if it's less, then it could be less. So I'm going to show you another example here in a second. So this is an example of the same couple, John and Mary, okay? But let's say they only converted up to the 12% bracket because they were nervous to go higher. They didn't know how high to go to IRMA. They didn't want to pay any IRMA penalty. They weren't sure how to do this. They dropped their lifetime tax savings by about 3.7%. So now they're going to save 3% lifetime. They're still saving, which is great. So they're dropping their taxes by about $319,000 per year. And they're increasing their legacy by $210,000 per year. But they're still overpaying their lifetime taxes by over $200,000 by not optimizing for the right bracket. Okay, so this is very powerful. And I think there's a lot of people here in this group on this webinar that probably have accounts this size. And so if you do, you definitely want to reach out and get a good tax planning strategy going, okay? So this couple here, I do want to emphasize that you don't have to have massive accounts to experience a large benefit from a good Roth conversion strategy. This couple here, they're the same ages, okay? Steve 69, Jane 67, but they have half, and I made this specifically 50% of that amount. And their optimal bracket is actually Irma bracket 1. So it's up to $212,000 for the year. And with these folks, they have $835,000 combined between their two pre-tax accounts. And even here at $835,000, their total estimated lifetime tax savings for this couple is over $300,000. So if you have $835,000 in retirement and you could have $300,000 more in retirement spending just by getting your distribution strategy, how would that change your life? I think for most people, it would change their life pretty significantly. So I want everybody here to have a good tax planning strategy. So hopefully after today, it becomes something of focus for you. All right, so I want to just touch on RMDs really quick because RMDs are very important to follow the rules for, but there have been a little bit of updates, so I want to touch on that. When you begin taking your RMD depends on your birth year. So if you're born before 1951, it's age 70 and a half. 1951 to 1959, it's age 73. And if you're born in 1960 or later, now you have until age 75. So this has given us some extra runway to plan for distributions, to plan for Roth conversions. Really, this has been a great update for most people. So in 2025, those who must take their RMDs is people that turned 73 in 2024 or earlier, and those with inherited IRA beneficiaries, okay, with some exceptions, of course. But if you have an inherited IRA, you want to make sure you take that RMD, and anyone 73 plus with traditional IRAs, 401ks, 403bs, and other qualified plans. The key deadlines, the first RMD is due April 1st of the year after you turn the required age. So if you turn 73 in 2024, you have until April 1st, 2025 to take that RMD. But what the problem is, the next year, you're going to have to take it by December 1st. So let's say you turn 73 this year and you wanted to wait until 2026 to take the RMD by April, you're still going to have to take an RMD for 2026. So you're going to essentially double up on that RMD for next year. So depending on your situation and your overall income expectations, it may be better to take it now or take it next year, but that is a flexible option. The penalty for missing is substantial, but it has gone down significantly. So now it's only it's 25% of the RMD amount. It used to be 50%, so that was definitely much higher. That should have been withdrawal. And it's reduced to 10% if you correct it in a timely manner. So they've really reduced you could say the slap on the hand for not taking your RMDs on time, but it used to be very significant, but not as bad now. So RMDs can get a little bit tricky if you have multiple accounts. I'm a big fan of simplifying things, but if you're somebody who has multiple accounts like a traditional IRA, a SEP IRA, simple, and rollover IRAs, you can take the RMD from any single IRA that you want or combination of them. But the way you have to figure it out is you have to calculate the RMD for each IRA individually, but the withdrawal can be consolidated and taken out of one account, okay? For 403B accounts, you can calculate the RMD for each 403B account, but you can withdraw the total RMD from any one or more of your 403B accounts. So those are some separate rules. Aggregation is not allowed for 401ks and other qualified plans or 457Bs. So you must calculate and withdraw the RMD separately from each 401k and other qualified retirement plan account. And for 457s, you must withdraw the RMD separately from each 457B account. When it comes to mixing account types, you cannot use funds from an IRA to satisfy an RMD from a 401k and vice versa. So you want to make sure that you get this strategy right because this can be a little bit painful on dependency. Even 10% is a lot if you get it right after you fix it. Okay, for those of you that are givers and you want to look at giving away some money this way, a very tax advantage way to give if you're age 70 and a half or older is to donate to charity directly from your IRA. This is called a qualified charitable deduction, also known as a QCD. So you can donate up to $108,000 per year this way. And the great thing is if you are in that RMD stage of life, this does count towards your RMD. And so the cool thing is if you have an RMD and you want to give some money away, that donation is actually excluded from your taxable income if you do it as a qualified charitable deduction, right? So this is especially beneficial if you don't itemize deductions, but you must be 70 and a half to qualify, or older, I should say, and the donation must go directly from your IRA to a qualified charity, not a donor advised fund. Okay, so this is something you want to get talking to your custodian about now, because it can take time to process these things. So really important to do. Okay. All right, so if you really want to maximize some of your impact in your life, you want to look at how to optimize your strategic giving, okay? Because you're a generous person, but I still think you should do it in the most smart way you possibly can. So I want to highlight a couple strategies here. One is giving away appreciated securities. So if you donate stocks or funds held over 1 year, this allows you to deduct the full fair market value and avoid capital gains tax. So this can be done really at any time. You don't have to be 70 and a half to do this. And you can also use what's called a bunching strategy. So if you might want to combine multiple years of giving into 1 year, that allows you to itemize it in the giving year and take that standard deduction in other years. So using a donor advised fund can help maintain the steady giving. So donor advised fund can be really powerful for somebody in a situation, especially if you're somebody who has like a lot of company stock, for example, or single stocks you invested in, can be great to use. So these strategies can help maximize the impact and tax benefits of your charitable contribution. Okay, the triple tax advantage of an HSA account or a health savings account is actually the most powerful, but the amount you can put in every year is very limited. Okay, so health savings accounts, if you can qualify for them, you have to be in a high deductible health plan. It has to be an HSA qualified plan. But in 2025, the HSA contribution limits will be $4,300 for individuals and $8,550 for families, with an additional catch-up of $1,000 for those age 55 and older. In 2026, those go up slightly by $100 to $4,400 for individuals and $200 for families up to $8,750, with that still $1,000 catch-up remaining. And like I said, it's important to note, in order to contribute to an HSA, you must be enrolled in a high deductible health plan, and the amounts are on the guides that I sent to you. The other thing you have to be careful, though, is if you're going on Medicare, okay, you cannot be on Medicare and still contribute to an HSA, so you need to stop your contributions. And when you take your Medicare versus how much you can put in the HSA, it's proportional. So let's say you take your Medicare on starts on July 1st, you can put half the HSA contribution for the year, but then the rest of the year you cannot. So you want to be very careful because you're going to have to back the money out if you over-contribute there. For those of you that don't have an HSA, but you have an FSA, also known as a flexible savings account, which is still tax deductible, so we're going to take the tax deduction. The difference is an HSA, you can roll over the amount, right? You can let that money roll over every year. For an FSA, you have to take the money out and use it by the end of the year. You might be able to have a grace period and roll over some of the remaining funds, because some plans do allow you to roll over up to $640 to the next year. But if you that account's kind of like a use it or lose it. So the remaining FSA funds on things like prescription refills, new glasses, contacts, dental work, medical equipment, get those appointments in now. I know my dentist is busy, but spend that money, because if you don't use it, you will lose it. All right. When it comes to managing Medicare premiums, your 2024 income is going to affect your 2025 premiums. Your 2025 income is going to affect your 2026 premiums. So really want to look at some things here to consider is timing your Roth conversions carefully, managing capital gains realizations, consider using a municipal bonds for tax-free income, and looking at life-changing events that may allow appeal, okay? I think it's on this next one here. Let's see. No. If you are going through a life stage, so let's say you are going from working full-time to part-time work as a work reduction, or from full-time work to work stoppage, for example, you can actually appeal Medicare Irma premiums, and you might be able to get a one-time get-out-of-jail-free card if you're going through a life change like that. So that's something you want to look into for yourself. Okay, a couple updates here. This is very important for those of you that are going to take Social Security prior to full retirement age, and you want to continue working and having an earned income, okay? So it's earned income from your W-2 income or from self-employment. This can impact you. Once you are taking your Social Security and you're prior to full retirement age and you're earning income, there is a limit, okay? And if you earn above these limits, you start losing $1 of your Social Security income for every $2. Yes, there's a readjustment period. Yes, you'll get it back eventually, but it might take you a decade or more, okay? So if you're going to be taking Social Security prior to full retirement age, and it's not the year you're reaching full retirement age, the annual income limit is $23,400 for this year and $24,480 for next year. So if you are going to work, you want to keep your earned income below those amounts. The year you're going to reach full retirement age, so let's say your birthday is in November and you're going to be reaching full retirement age and you want to take your Social Security in January of that year. Now the earning limit is $62,160 for 2025 and $65,160 for 2026. That's a pretty big jump. But above that amount, then you'll lose $1 for every $3 over the limit of your Social Security benefits in that year. Again, it gets recalculated, you eventually get it back, but it just really sucks to be basically working for free at that point if you earn over that amount of money. The 2026 Social Security COLA has been announced. It's going to be 2.8%. Whoop-de-doo, so pretty decent, but it's normally what we expect. We are coming up close to the end here, so bear with me a few more minutes, folks. This new TRUP account can be super powerful if you have young kids or grandkids, okay? So the contribution limit is going to be $5,000 per year per child under 18. You cannot contribute after they turn 17, I believe, or beyond the year they turn 17. You can use your annual gift exclusion of $19,000 to fund the account, and the accounts get tax-free growth if used for qualified purposes. So a lot of this is getting worked out. It's going to be similar to a 529, but it's going to be more flexible, okay? So a 529, it's more limited. With the Trump account, they're saying that you might be able to use that money to put a down payment on a house, for example, or fund a small business. That could be a really useful thing for some kids as they're getting to the age of 18 or older. So again, this is not all clear yet. I'll do more discussing about this account as we know more about it. But if you have kids that are being born in 2025 or 2026 through 2029, they can start this account and they get $1,000 to start the funding of it. If you didn't know, I have a baby due here pretty soon. So hopefully we're going to get that $1,000 and we'll get that started for ourselves. For those of you with students, the American Opportunity Credit has gone up. So it's 100% of the first $2,000 plus 25% of the next $2,000 of expenses. So up to $2,500 per student. The phase out is $80,000 to $90,000 for single filers and $160,000 to $180,000 for joint filers. Lifetime learning credit, 20% of the first $10,000 up to $2,000 per return. Same phase out ranges there. Really good benefit of this new O3BA, the One Big Beautiful Bill Act, is this tax law stability, okay? So these extensions to these lower individual tax rates have been made permanent, and I keep that in quotes because someone could technically change, but they're not going to for sure reset next year. The higher standard deduction, if you remember early in the year, it was $15,000 for single filers and $30,000 for joint. It's now $15,750 for single and $31,500 for joint. The qualified business income deduction, for those of you that are self-employed, you get 20% off the top. That's been made now permanent as far as we know. And then the $15 million state tax exemption, that's been great. And then the new benefits for seniors, the $6,000 for 65 and older. No tax on tics, no tax on overtime. The higher SALT cap, that's for 4 years now. And the enhanced child tax credit. So all of these things you want to maximize over the next 4 to 5 years here because they could possibly go away. So make sure you include them in your tax planning. For those of you that are self-employed and you have any sort of pass-through type of business, you can take 20% off your qualified business income. And that's for single filers between $201,750 up to $276,750, and married filing joint between $403,500 and $553,500. So there are limitations that do apply for specified service trade or business, but 20% off the top is a wonderful thing for our small business owners. So at year end, you want to consider accelerating or deferring business income and expenses to make sure that you're going to qualify for this. Because if you get into a phase out, you might want to put more money in a solo 401k or a SEP IRA, for example, to maximize this deduction. But if you're not in the phase out, you might want to put more money in your Roth account so that you get the full 20% off the top, which is a really wonderful deduction. So this gets really tricky for your small business owners. All right, so last couple slides here. Here is your December checklist. And I've given you a checklist by email. It has a lot of things on there for you to go through and review. But the main things you want to look at to start are reviewing your estimated tax payments. Make sure you've made your estimated payments appropriately. You didn't over or underpay. You don't want to give the government a free loan. And you also do not want to owe a penalty. Consider your Roth conversion opportunity. There's still time left to do this for this year, okay? Harvest any gains or losses strategically and make any final retirement contributions. If you have any giving, the charitable donations need to be done by 12/31. Those have to be executed by 12/31. You have your annual gift exclusion of $19,000 by the same date, and a QCD if you're age 70 and above. For healthcare, use all your remaining FSA funds, maximize your HSA contribution. The HSA contribution you can still put in until after the year, and I think it's April 15th. You want to schedule deductible medical expenses strategically. For retirement, take those RMDs if you need to take those. Review your beneficiary designations. That's a really important one. I put a checklist on there for all your accounts on the one I sent out. And consider any retirement plan changes for 2026. If you need to increase your contributions, make sure you plan for that. And so mark your calendar here. Here are the dates for the things I just talked about there between December 15th or April 15th. Yes, HSA is April 15th. And now I will pause for questions. I think I saw one come through. But thank you for hanging out with me on this marathon. As you can see, there's a lot to think about at the end of the year. And someone anonymous said, I think you might be my favorite nerd from another nerd. Hugs and kisses. Thank you so much. I appreciate that. Wonderful question. But if you have any questions, go ahead and put those into Q&A right now. If you're on here live, you get the benefit of asking questions to me live, okay? I can't promise I know all the answers, and I may tell you I need to follow up with you. But take this opportunity. Again, I've been doing this for a while. I'm not going to tell you that I know everything, but I do want to be able to help you out, okay? All right, good question. So a question came through. Can you take a Roth conversion one year and not the next year? Absolutely. And you can do different Roth conversions amount each year. A client that I've been working with for a number of years, I recommended he go really heavy because he retired early. I think he's around 57 or 58. But he retired really early, way before Social Security. So I recommended, hey, let's do some big conversions. And we did some years $200,000+ of Roth conversions because he had no other income. And now he has over $1 million all in a Roth account, and the majority of his money is now in a Roth account. So really powerful. And then now that he's on his pension and taking Social Security very soon here, I think we're going to start this year, we're going to be bringing down those Roth conversion amounts. But now he has a huge pile of money all in his Roth account that's going to be compounding now tax-free forever. Really good question there. Great. Okay, next question here. If you are retiring next year, does the income you make on your current W-2 job count against your Irma cap? So technically the answer is yes, but there is a form you can file called SSA 44 that allows for change in status of some sort, okay? So if you look at that, I can probably pull it up right here. Let's see if I can pull it up. SSA 44. Okay. And I got a new hack for you. Okay, I'll tell you in a sec. So there's this form here called SSA 44, and it's for your Medicare income-related monthly adjustment amount life-changing events, okay? So you need to fill this out. It's pretty straightforward. It gives you the income guidelines here. But if you have any one of these events down here, where'd it go? Here we go. Type of life-changing event. You got married, divorce, death of your spouse, work stoppage, work reduction. So the question from this anonymous attendee here, if you're retiring next year, does the income you make on your current W-2 job count? You may get a notice if you go on Medicare that you have a penalty. But if you file this form, I can't guarantee anything because I'm not the Social Security office, but what I've been seeing is it's around 3-week time turnaround. And as long as your income is either going to go to zero because you have work stoppage, or you're going to go to, let's say, a lower working amount and you can have a work reduction, you should be able to qualify, okay? These other items too, loss of income, producing property, or loss of pension income, these are all things that potentially could change that end of your income. So really good question, and you want to make sure you get that form filed appropriately, okay? Okay, so David says, we recently inherited a significant tax-free account from a parent that required us to withdraw within 5 years. This has created an Irma issue. Can this be appealed? So if you inherited a tax-free account, it wouldn't create an Irma issue. I'm assuming you might have meant a tax-deferred account like an IRA of some sort. So in this case, I don't think you can appeal this year for sure. You might be able to appeal after the last year that this is coming up, but this is not really one I think you can appeal on. And this is going back to my point I was making about your Roth conversion strategy. You don't want to be like David here and get put into a spot where you're just wasting thousands of dollars that go to Irma, that go to taxes. If you're somebody who plans today strategically with your distribution and conversion strategy. Imagine if David was set up with a purely tax-free account that was in a Roth account that he could delay taking all the money out till 10 years from now and let it grow. He'd be in a much better position, but really good question. And David, if I'm wrong about my assumption here, because you said tax-free account, but then you have an Irma issue, it just doesn't make sense. There's something missing there. I have a feeling it's a tax-deferred account, and please correct me if I'm wrong and make another question. Thank you. All right, so Dean asked, what do I think about annuities? I think annuities are great for the right person, right? You have to remember, if you have Social Security, you all have an annuity of some point, right? Or of some kind, I should say. If you have a pension, now you have two annuities. So what I see a lot of times is people putting too much money into annuities, but I'm not a fan of doing what's called a floor strategy with annuities. Let's say you have $3,000 from your Social Security coming in per month, and let's say you needed another $1,000, so a total of $4,000 to meet all of your minimum needs just for the basic expenses. If you got a fixed annuity of some sort that paid you $1,000 a month for life that's inflation adjusted, and that made you feel better and you slept better at night, then there's nothing wrong with that. I personally, most of the clients I work with prefer what I do, which is called a bucket strategy, where we have money in what's called our now bucket, our soon bucket, and our later bucket. So I manage the three buckets for them, and we keep somewhere between 2 to 5 years, depending on their risk tolerance level, of money in very safe assets. And so when you have a cash account that's making, let's say 4%, and you have some short-term bonds that are making like 6% they made this year, and then some longer-term bonds that are making maybe 6, 7, or 8%, and that's in your first 5-year bucket, you're going to have money there that's liquid. And the thing with annuities is the money becomes a little bit illiquid, not all annuities, but most of them. And so it's a trade-off, okay? But there are some good annuities out there. There are good annuities for short-term. There's one called a MYGA, M-Y-G-A, could be pretty good for a 3 to 5 year period. But this is very individualized. I do not generally recommend you put all of your money into an annuity because the fees and expenses are not great. But if you're somebody who can handle a little bit of risk, that bucket strategy is usually a better bet for most people. So thanks for the question, Dean. Really good question. And it looks like David, he misspoke, so I was correct on that. So thank you for that, David. Thanks for clearing that up. So I don't see any other questions, folks. I have a couple spaces left this year for consultations. But what I would really want to do is talk to you about next year, all right? Really, I would like to talk to you about next year because this year is very close to being over. Again, I have a couple spots left. So if you're somebody who really wants to look at a Roth conversion situation this year, let's do it. Let's talk about it. But if you're not, and you can wait till next year, let's talk about next year because if we can start planning now for the next 5 or 10 years, that's going to be a lot more powerful than just trying to cram everything in the next few weeks. What you really need is a long-term income and distribution plan, okay? So what I want to offer to you is for everybody here, okay, that's attending live, okay? If you want to get a free analysis, okay, there's let's see if this will come back up, no obligation, okay? And you see those screens there where I was able to show, hey, this is what it looks like a good bracket for you to convert to would be. And you want to know also about what I think you could safely spend in retirement because a lot of people don't know what they can spend. And I think that's a big challenge. I will offer you a free analysis there. And what I will do is send you a link. And this link, it's like a AI type of builder where it's going to ask you questions. You're going to fill it out. And then it'll send it back to me. And then I can give you some ideas and some insights around what I think would be a good strategy or plan for you. And if you then want to meet with me personally and talk about how we implement that, then we can do that again. That's totally free of charge. But for everybody who is on this live, and you have to prove to me you're on it live, okay, or at least that you signed up for it through the Zoom link or in the Facebook group, I'm more happy to do that for free. I want you to email me, info@keepitsimplefinancial.com. And then I can send that back to you by email. So make sure you give me your name and email. And then the data gathering tool is going to ask you the questions, like I said, and get the information from you. If you have a balance sheet, you could just send me. That's really easy as well. I can just do it with the balance sheet. That's totally fine. But the intake tool is really useful. And it's done like with an AI thing where it asks you questions based on what you answer. So it's pretty cool. That's 100% free. If you have any questions, call the office, 877-6-RETIRE or 877-673-8473. Monday through Friday, generally 10 to 5 or 10 to 6. Jeanette's going to be answering the questions. That's my operations manager. And if you want to reach out to me directly, info@keepitsimplefinancial.com. If you want to check out what we do and how we do it, just go to my website, keepitsimplefinancial.com. One thing that I will promise to you, because for those of you that have been around a while, I used to do these every week. Going into 2026, I'm going to be doing these a lot more. I really love these, and I would love to hear from you. Do you have any feedback for me? Is there anything I could have done better? I want to make these useful and valuable to your time as well. Please feel free to shoot me an email and let me know that as well. But other than that, folks, that's what I have for you today. This recording will go out once it finishes processing. If you did not get the 3 guides that I sent out earlier, I sent them out about 11 a.m. today, I think, Pacific time. Email me, because those went out to probably 60 plus people that did register ahead of time, but a few people did register after, so I will send those to you, no problem. And other than that, folks, I wish you a wonderful afternoon, happy Sunday. Yeah, I'm going to send this out. Now, my pleasure for the thank you, and I will be sending this out. I'm going to clean it up a little bit through some editing, and then I'll send out the copy. If you have any other questions, folks, reach out. Have a wonderful Sunday. Thank you for your time and attention, and I look forward to seeing you on the next one. Have a great day. Bye now.